Good morning. Thank you for being here. Today, we are talking about guardianship and wealth, specifically what you need to know about managing portfolios responsibly. Guardianship comes with a couple of unique challenges: fiduciary responsibility, balancing risk and return trade offs, and making sure that there's enough money for today while preserving those resources for tomorrow. But I want to share a story with you about how managing more wealth doesn't always lead to easy success. And I'll give you an example. So, has anyone been to the Biltmore Estate in North Carolina? It's beautiful, right? It was once owned by Commodore Vanderbilt, and when he died in 1877, he left $105 million to his heirs. That's the equivalent of $3 billion today. But here's the plot twist: no one taught the next generation how to manage money. They spent it like it would never run out, on parties, yachts, Manhattan mansions, until it was essentially all gone about 30 years or so later. Sounds like there should have been a lot more oversight, or maybe a little financial education along the way. Building wealth means knowing where to invest. Keeping wealth is about protecting what you've built. And we're here today to protect the board's assets. We want to ensure that they are properly managed, growing, or dispersed in accordance with any court orders, those legal documents, or an estate plan that has been put in place. So I'll briefly introduce myself. I'm Cassandra Smalley. I'm the founder, owner, and self-proclaimed financial joy maker at Cassandra Smalley Wealth Management. I specialize in retirement planning, tax planning, and investment management. I am a certified financial planner professional, and I hold the Chartered Financial Analyst designations. Those are considered kind of the gold standard in the financial advice industry. And it's a combination that are actually held by fewer than 1% of financial advisors. I am on a mission to do my part in closing the gender wealth gap. So I also wrote a book called The Why of Wealth: Mastering the Steps to a Wealthy Mindset to Live a Joyful Life. And the goal of that book was to empower more women to reach financial freedom and enjoy living it. So I worked for big firms and smaller ones. And previously, I managed about $500 million in assets for 350 different families before that practice was sold. And when that took place, I knew I wanted to work with a much smaller number of clientele, where advice was much more personal and clients don't have to feel like they're just another number. Now, over my career, I feel like I've seen it all, but there's still one story that sticks out to me to this day, and I want to share that with you. So I want to take you back to March 9th, 2009. I took a call from a grandmother that day who had reached her wit's end. Now, if this date rings a bell, it's because it's the absolute bottom of the Great Recession. It was a time when people were losing their homes, their jobs, and their investment accounts had already fallen by more than 50%. Listening to the news, it would seem like financial Armageddon would never end. People were calling in a panic. And I took a call this day I wish I could do over, because it's the day the one got away, and I've been determined ever since not to let it happen again. You see, a grandmother called and could not witness her account decline anymore. At the lowest point, the worst possible time, I could not talk her off the ledge, and she sold her granddaughter's college account to cash. What was impossible to know at the time is that date marked the bottom. It's only visible in hindsight. Months and years later, the market recovered just as it always has, just as it always will. But her emotions and fear got the best of her. And that one decision, that one costly decision based on fear and emotion, impacted her granddaughter's ability to afford college. Why does this story matter? Because seemingly simple investment decisions have the ability to have an extreme ripple effect, even across generations. When we are overseeing someone else's life savings, it's even more critical to ensure that the right professionals are at the financial table. Now, our goals today are first to understand how those fiduciary principles apply to investment oversight. Second, I want to walk through a practical risk management and asset allocation discussion. And third, to explore how to evaluate those liquidity needs without sacrificing long-term financial sustainability. You see, in the context of the investment management world, a fiduciary duty means that we are legally required to act in the client or the ward's best interest. We have to make prudent investment decisions, and we have to balance those current needs with that future sustainability. Every choice, whether it's stocks or bonds or real estate, it all must tie back to those duties and responsibilities. And a fiduciary advisor is able to assist in this capacity through helping to organize and make sense of their financial life. They're going to be able to help streamline that investment management process and ensure accounts are properly established, they're titled correctly, and those appropriate restrictions are put in place, if any. Secondly, a fiduciary advisor will help establish a thoughtful and well-documented process for managing the ward's assets. They'll also help you establish an investment policy statement. And the goal of this document is to have a clear understanding between the guardian and the advisor as to the investment goals and objectives of that investment portfolio. This sets the foundation on which all decisions are made. It helps limit your liability with that documented process and allows you to report back to the court. So if you are in the market for finding that fiduciary financial advisor to oversee the ward's portfolio, I want to ensure we set the landscape for all of those in the industry that might call themselves financial advisors. So it's not like the term doctor or attorney, which does have title protection. And it's important to understand that advisor's capabilities, but also any limitations which might be imposed based on the company that they work for, as well as understanding very clearly how that advisor is compensated. And I want to share a personal experience with you. So it was almost 20 years ago that I sat in a planning meeting with one of our top producing financial advisors. And the charades he played in that very meeting changed everything I believe about this industry. And I'll never forget that moment. So as we're in this meeting, alongside the company's top salesman, someone we were all told to admire because quarter after quarter he hit his numbers, the client we were meeting with was around 60, recently divorced, and just wanted to learn how to invest. And of course, I was young, ambitious, and curious, and I wanted to know how he was helping so many people and building such a successful business. And then it happened. Right in the middle of the meeting, he paused, looked at the client, and smiled very charmingly and said, "Okay, I'm going to put on my fiduciary hat now." And he made a showing of lifting an invisible hat off of his desk and placing it on his head. Why does that matter? Because he was recommending an investment portfolio. And for that recommendation, he is required by law to act as a fiduciary, meaning legally bound to put the client's best interests first, just like your CPA or attorney. It's what he thought was best for her. 10 minutes earlier, however, he had already recommended an expensive annuity, handcuffing her money to that insurance company, which he admitted later helped him reach his quarterly sales quota. And for that part of the meeting, the fiduciary hat wasn't on. It felt like a magic trick, but the kind where the client was the one being fooled. And that moment really shook me because I realized if I stayed in that world, I'd either have to play along or walk away. And I chose to walk away. It's why I built a firm that's 100% fiduciary 100% of the time, because people deserve real advice with something so important as their life savings, not a sales pitch with a costume change. So a registered investment advisor is the only structure that is required by law to act in that fiduciary capacity 100% of the time. Other financial institutions might also be limited on the advice that they could provide, such as they may not be able to go into estate planning conversations or have detailed tax planning conversations, or they might be limited to that firm's inventory. They're only able to provide certain investments based on what's on their shelf, just like maybe a car dealer is limited by the inventory on their lot. Versus someone who's able to look at the entire landscape of available investment options and give the client a really honest and thorough opinion about what's best for them. So when looking for a financial advisor, I recommend asking 3 questions. 1, is your firm an independent registered investment advisor? Number 2, are you a CFP professional? And number 3, are you fee only? Which means they are only compensated by the fee that you pay directly to them. They're not fee-based or incentivized in other methods, which might mean that their fee is based on the products that they sell. And I believe that fee transparency is very important. So what you should expect when working with a financial advisor is starting with that detailed investment policy statement. That will set the expectations for how your portfolio is to be managed. Every decision should be in alignment with that document. And when working with the ward's account, it's very important to document any transactions that are related to the investments, any transactions that are related to the withdrawals or spending decisions, and any recommendation or change in strategy. And we'll go over a few other examples in a moment of what else can be included. There should also be quarterly portfolio reviews as we're collaborating with that ward's fiduciary team and incorporating scenario planning into their financial plan. That could be as life changes, but also as estate laws change or tax laws might change year by year. And one of the challenges that guardians may face is also pressure from family and watching out for things like elder abuse or elder exploitation. This is a critical area of fiduciary oversight, and it can take many different forms. So it could be an unusual account withdrawal, a sudden or new relationship that might have some financial influence, or bills that are going unpaid even though those funds are available. As guardians, your role includes not only overseeing that the assets are properly managed, but also ensuring that the ward isn't being exploited. And that means keeping clear documentation, setting up those checks and balances, collaborating with attorneys or accountants or other professionals when needed. That fiduciary advisor can help with all of that as well. So I'll give you a couple examples. In one case, I had a client with terminal cancer. He was in his 60s and he began a new dating relationship. His adult children were not so fond of this new relationship, and that ended up causing a lot of family tension, so much so that he stopped speaking with his children. The client then began a little bit different activities that were out of the norm for him. He bought new land. He wanted to build a second home for them, a vacation home. He also began renovating his current home. And the adult children became increasingly concerned as he continued to spend really lavishly to give her this great home. And he saw that the children's concern in his spending as their greed in order to protect their future inheritance. There were a lot of phone calls with our office, with their estate planning attorney. It was noted that he had full capacity, and eventually, unfortunately, new documents were drawn, and that ended up essentially excluding the children from his estate. In a separate instance, it was almost the reverse that unfolded. So elder dad passed away, who was the primary person who was responsible for the family finances. Elder mom was not so familiar with handling money. She had 4 grown children, and in a way, they almost seemed to be coercing mom into gifting them money now rather than waiting on their inheritance in the future. And honestly, that's not uncommon. A lot of parents that have excess retirement savings want to be able to see their kids benefit and enjoy those resources now rather than waiting till they're gone and they're not able to see them benefit or enjoy them. So in that instance, the challenge that we saw was that it ended up wiping out almost $2 million of her net worth. And that could have been needed for her care as her age continued to advance. The challenge was also that she began to show signs that she may have some diminished capacity. So as one child would ask for a gift, the others seemed to become jealous and would seek out more. A corporate trustee was eventually named to manage what was left in her portfolio and essentially put a stop to the Bank of Mom. But these are the type of situations that you need to look out for and that we may see occasionally to make sure that we are protecting, the client's money is being protected from others, as well as sometimes even protected from themselves. Now, within that investment policy statement that the financial advisor is going to help draft, there's a variety of items that will need to be discussed and included. Generally, this conversation might start with some form of a risk tolerance assessment. And as we're planning for the financial goals of the ward, it's also important to discuss their risk capacity. And the difference between those two is that the risk capacity is their ability to accept risk and volatility based on the resources that they have. Whereas the risk tolerance is their willingness to do so. So they actually have the stomach to tolerate those market movements. Sometimes those two things don't always align, and that would be something that would need to be noted. A ward who might have sufficient resources to tolerate more volatility might lean a little bit more towards a growth-oriented portfolio. Conversely, if the ward's assets are very limited with a higher withdrawal rate compared to the size of their resources, their risk capacity might be much lower and warrant a more balanced or conservative approach. Now, the other items that should be documented are things like the overall account strategy, their liquidity needs, their time horizon, the tax implication of each account type, the duties and responsibilities of that investment advisor, the duties and responsibility of the client, and anything that's still left up to their discretion, the overall investment philosophy or investment principles, and then any actionable steps for ongoing management, like monitoring and rebalancing policies. So when looking at a risk tolerance and setting that asset allocation policy, what we're broadly talking about is diversifying across three main asset classes: stocks, bonds, and cash. And those can be further broken down a number of ways. So U.S. stocks versus international stocks, large companies and small companies. Within the bond market, we're looking at government bonds or corporate bonds or municipal bonds. More liquid investments, we're talking about things like CDs or money market funds. But that allocation is that mix of these different categories. Now, the higher the risk tolerance or risk capacity with a longer time horizon or a smaller withdrawal need, generally, in those cases, a larger percent can be allocated and can be invested in stocks. Stocks just mean you own a piece of a company. As that company grows, the profit or earnings of that company generally increases the stock price over time. Now, the lower the risk tolerance or a higher cash need, the more is likely to be held in bonds and cash. And I think a lot of people are familiar with how CDs work at the bank, so I often use this as an example to explain that bonds work in a much similar capacity. So you are the lender to which you receive an interest rate over time for lending those proceeds, and then eventually you get your original principal back at maturity. What I think a lot of people underestimate is that with those more conservative investment vehicles like bonds, their price can still fluctuate as interest rates are changing over time. And it works in an inverse relationship. It has this kind of like seesaw effect. So if you can imagine, as rates go up, bond prices go down. And when interest rates go down, then bond prices go up. Additionally, their expected return is going to be much lower because of this structure. So you don't actually own the company. Remember, you're lending money to that company. You're not benefiting necessarily directly from the profits of that company. You're getting a fixed rate of return, fixed rate on the money that you lent. Now, owners of stocks should be expected to be rewarded with higher long-term returns, more so than a bondholder would be, in theory. Now, within each of those asset classes, the investments, again, can be further diversified across sectors or industries. And we want to make sure, as we're reviewing their existing portfolio, we're avoiding things like concentration risk. So any concentration would be something that is greater than 5% of the investment account. So if a legacy position does exist that has that higher concentration, this would be something that would need to be addressed in that investment policy statement as to how it's being monitored, how it's being diversified or reduced if possible, and any tax implications or any strategy to reduce that concentration risk. It's also prudent to ensure that that asset allocation is appropriate and that the account is rebalanced accordingly as money is coming in or going out of the account, or even as the market moves. And risk is one of those words we hear everywhere, on TV, around the water cooler, and headlines. They love to stir up a little bit of fear. But when it comes to investing, I think most people don't actually understand what risk really means. And honestly, not their fault. The media often uses the word risk when they're actually talking about volatility. And those two things are not the same. So volatility, what is it? It's simply the ups and downs, the price movement around a trend line. Now, sometimes it's up, sometimes it's down. And depending on the trend line, the direction of that trend line, that movement could be a good or bad thing. But here's what you should know. For a diversified long-term investor, that trend line has been consistently rising, which means those ups and downs, the volatility, has not historically been risk as we're defining it. So then you may be asking, what exactly is risk? And I would define it as two different things. Number one, it's the possibility of a permanent loss of your money, permanent loss of capital. Or it's any choice that is going to move you further from your goals instead of closer to them. So let's talk about the first one for a second, that permanent loss of capital, that permanent loss of your money. That's the nightmare scenario, right? And yes, it can happen. So when you think back to things like Enron or WorldCom or Lehman Brothers, recently we had Silicon Valley Bank. If all of your money was riding on one of those companies, you could have lost everything at that time. That's why you hear the term, don't put all your eggs in one basket. That level of concentration is risk. The opposite is diversification. So diversification exists to protect you from that kind of disaster. But for a diversified investor, that idea of a permanent loss of capital hasn't happened in the history of the US stock market. In fact, the opposite has happened. Since 1960, the market is up 117 times, and that's not even counting the dividends that have occurred. And if that feels like ancient history was a little too far back for your taste, let's fast forward a little bit. Let's make it a little more recent. So looking at if you had $100,000 invested in 1990 and reinvested dividends over that time frame, that would be worth more than $3.5 million today. That's a 35x return on your money. Now, of course, past performance doesn't guarantee future results. We all know that. But based on this history, calling the market quote unquote risky, the way we're told, feels like the wrong conversation. Unfortunately, that's not how it's portrayed. And headlines focus on what's happening this week or next quarter. And that temporary volatility is constantly mistaken for that idea of a permanent loss. Understanding this difference is the key to staying confident and making smart choices and keeping your long-term goals front and center. So the reality is this: the stock market has been the most powerful, the greatest force of wealth expansion in human history. But one of the most difficult parts of investing is not choosing what to buy and sell necessarily. It's the human side of investing and managing those human expectations. And I honestly think this is the most valuable piece of what investors get from hiring financial advisors. Because oftentimes, I can't tell you the number of times, I help prevent those multi-million-dollar behavioral mistakes and occasionally talk people off the ledge during a financial crisis. Now, let's talk about fear. What is fear? And so I'll explain a little basic understanding to kind of set the framework here. But this idea of fear, it starts in our brain. And it sends this alarm throughout our body, helping us decide which response to take. Remember fight or flight? And this mechanism worked really well in prehistoric times. We needed to be prepared to spar with our weapons or flee up a tree to avoid predators. The anxiety starts to kick in. And when that happens, it can begin to overrule the prefrontal cortex. And that's the part of our rational brain that knows that you already have a solid plan in place, that we're okay. The amygdala helps us process those strong emotions like fear, pleasure, anger, and it encodes our emotional memories. So those money decisions and our experiences with money, even back to childhood, often impact those same emotions. Other parts of our brain help us determine whether a threat is real. So a simple example, when I took my kids to the zoo and we saw an alligator exhibit, we knew we were safe from harm's way because there's a rail there. But just a few weeks ago, I was swimming at the springs and a small alligator was swimming just a few feet away from me, and I had to determine my escape path. When you turn on the news, the messages scrolling across the screen can elicit panic as bold red numbers are flashing when the market trends down. Breaking news stories appear with quote-unquote experts weighing in, and it can trigger that same fight or flight response, which is not what we want to happen when we're dealing with something so important as someone's life savings. Just remember this: financial journalism is not there to just provide you the information. They're there to ensure you continue to watch their show. Fear is always in the media. During times of financial crisis, honestly, the best thing I tell people to do is probably turn it off. But that amygdala's fight or flight response can lead us to sell at the worst possible time due to those emotional reactions of the moment, just like the grandmother in our earlier story. The rational response would be to evaluate how long that danger might last, and with a proper plan in place, the best thing to do is often just to stay the course. Because positive returns are rewarded to long-term investors. Now, clearly, no one knows what the market's going to do in the future, but I do know that time is on your side. And I like to think about investment strategies in buckets based on timeframes. So if the ward has an immediate cash need in the next year or two, certainly those funds should be ultra-conservative and not invested in the stock market. The funds that will be used to fund a future retirement or long-term care needs down the line and won't be needed immediately can often be invested in more stocks because they have that time horizon. They're not going to be needed for quite some time. What's amazing to see by this illustration is that the chance of having a negative return by investing in the market over most 10 or more year time horizons in history is almost non-existent. So while I can't guarantee that in the future, I do know that time is on your side if you are a long-term investor. Now, this chart, I recognize it's a little busy, so we'll talk through it, but this chart shows the total price return and the maximum drawdown of the S&P 500 in each year since 1980. The red dots that you see at the bottom are the lowest decline from the highest point within that calendar year. That's the average intra-year drop from the high point. And that average drop was negative 14%. However, look at how the market has performed despite that volatility. The gray bars are how the market actually finished the year. And what's amazing to see is that despite those significant intra-year declines, the S&P 500 has finished the vast majority of the years with positive returns, many of which are sizable double-digit returns. And that should be very encouraging for investors to stay the course. Over this period, the average annual stock market return was 12% per year. And all you had to do was ride the wave. But sometimes investors usually use this idea of all-time highs as a reason to stay in cash or on the sidelines. However, history suggests that investing at all-time highs is not a bad strategy because new highs are typically clustered together. In other words, that market strength ends up fueling more market strength. So on the left, what we show is the S&P 500 and the green segments that you see where each time an all-time high then set a new market floor. Since 1950, there would have been many instances in which an investor sitting on the sidelines with markets near all-time highs would have never seen a better entry point. Now, on the right, someone did the math. We show that the returns from investing on any given day versus an all-time high are comparable. And in some cases, they were actually better when investing at those all-time highs. So the moral of this story is to not let the financial media scare you into thinking that all-time highs are a bad indicator and that you have to wait for a correction. Remember that this is investing, not gravity. It does not follow the principle that what goes up must come down. And for those that worry about crashes, I believe should be more worried about the market getting away from them and how they're losing a battle to inflation, which is a concept we'll see in a moment. Next, I want to talk about that balancing act between liquidity and growth. And you need to have liquid assets for things like medical care and housing and emergencies. But you may also need long-term growth so that the portfolio doesn't get depleted too soon. Good guardianship means that you're anticipating both, planning for today while protecting for tomorrow. Because inflation is a silent killer. It's one of the biggest reasons that anyone should be investing. And that means beyond bank accounts or money markets, beyond CDs and I-bonds, being too conservative may actually be riskier than investing in some cases. So think of it like this. It's like a hole in the bottom of your purse or your wallet, and the dollar bills are just leaking out a little each day due to inflation. Just to make the math easier to follow in our example here, let's say the ward needed $100,000 to sustain their normal standard of living. At just an average 3% inflation rate, that original $100,000 is worth about half as much in a little over 20 years. So a 30-year-old today, that means by the time that they're in their 60s, they wouldn't need just $100,000. They would need $200,000 or possibly more in income just to have the same lifestyle they had at 30, just by accounting for the inflation factor. So stocks, again, which are those ownership shares of a company, are a great way to grow money over the long term. And as we've seen on previous slides, they have consistently outpaced inflation. Now, years ago, I was managing a guardianship account for a young minor who had a restriction that limited to the investments to cash-like instruments only. And this is when interest rates were close to zero. They were close to 0%. And you could see how detrimental inflation could be for that child who, by the time that they have access to their account, they come of age, would have lost half of their purchasing power if it was just sitting in cash, not earning anything. So in that case, we encourage the guardian, work with the attorney, have the judge review the investment options for that case. And the judge decided to lift that restriction a little bit so that the ward's account could better keep up with inflation. But we have to balance the growth with liquidity needs, right? And you may have heard this term before, the 4% safe withdrawal rate, sometimes also referred to as the 4% rule. Please keep in mind, it's not really a rule, it's more of a guideline. But studies have been done to look throughout our history of what could be a reasonable withdrawal rate, or also called that safe withdrawal rate, to ensure that the ward or the client doesn't run out of money before they run out of time. And this research has been updated. The withdrawal rate is now a little bit closer to 5%, which actually is shown on this graph as well. But in the case of where we hear the 4% safe withdrawal rate, that seemed to be the standard for a 30-year time horizon. And 30 years was used because it was an average length of retirement. Again, we want to make sure that someone who retires in their 60s is not going to run out of money if they make it into their 90s. So the way the calculation worked, you would take 4% in your first year and then adjust it each year by the amount of inflation. So to make the math easy in our example here, let's say the ward had a $1 million investment portfolio. In that case, you could withdraw 4% or $40,000 in year one. Then, let's say in year two, inflation was 3%. You would then take that $40,000 original withdrawal and multiply it by the inflation factor times 1.03. And that would say you could now withdraw $41,200. Now, this theory assumes that you are also invested in a balanced portfolio of stocks and bonds, and that you also rebalance that portfolio each year. And what you see by this example, each of those lines is a different withdrawal rate. So the top two lines, that 4% and 5% withdrawal rate, worked under this timeline. They still had money left over at the end. But anything greater than that, the 6, 7, 8% withdrawal rates, you can see they ran out of money before that 30-year timeline was up. And this is a type of scenario testing or stress testing that the financial advisor will do to help address the ward's liquidity needs in the context of their investment strategy and the resources that are available. Now, if there are retirement accounts involved, tax planning will need to be taken into account too. So the advisor will calculate things like required minimum distributions or RMDs. They'll evaluate Roth conversions and other tax planning considerations. It's also important to consider life expectancy probabilities when we're building out that financial plan. The probability of one member of a 65-year-old couple will reach age 90 is 73%. Remember, average life expectancy, when you hear an average life expectancy, that is a midpoint. It is not an endpoint. So half the population will live longer than that average. Someone who has access to good health care and goes to the doctor is likely going to be on the latter half of that spectrum. A healthy individual should plan on the probability of living 30 years in retirement. Remember, the goal is to ensure that the ward doesn't run out of money before they run out of time, which is even more important if we're dealing with a ward who is very young, because investing a portion of the portfolio for growth is important to maintain that purchasing power over time, especially as healthcare costs continue to rise for older Americans. So to wrap up this discussion on guardianship and wealth, I like to use this illustration of the advice value stack. While most people come to me for the bottom part of the advice value stack to manage all of the details that deal with the investment accounts, I find that those that feel most satisfied and get the most out of working with a fiduciary advisor is when we can collaboratively move up that advice value stack. We're achieving goals, peace of mind, freedom from worry, having more discretionary time, and fulfillment in their purpose and legacy. So my goal at the end of the day is to take the stress out of finances so that you can focus on what you do best. I'd be glad to answer any questions now, or if anyone is interested in taking the discussion offline, my calendar is on my website at cassandrasmalley.com. Thank you.